Hello everyone, it's Tuesday, November 5th. Not like that's a big news day or anything. We have the NFL trade deadline, some big earnings reports, and this, little thing, I don't know if you've heard of the presidential election that's happening right now. And if you want my thoughts on investing during the election, go watch the video I just made. Think of that as my Dividend Data election special. But today we're going to be focusing on earnings that just came out for Super Micro Computer, ticker symbol SMCI. This is a very popular AI stock, which boomed up until March 2024. However, since then it has been facing significant problems and the stock has tanked 75% from its all-time high. And now after reporting earnings, it's down another 14.62%. So what exactly happened with this fast-growing AI stock, and does it now represent a buying opportunity? Those are the questions I'm going to aim to answer in this video. Let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoy the video. Throughout, I'll be using my stock research tool, dividenddata.com. We just launched our new AI chat feature, Ask Dividend Data, and to celebrate, we're doing a 50% off sale. Use the promo code AI at checkout to get 50% off for life. You can also sign up with the link in the description and pinned comment. And I've been using that AI tool to help me analyze the latest quarter and earnings call for Super Micro Computer. But first, let's just take a look at their business and try and figure out how they make money. So Super Micro Computer, ticker symbol SMCI, is a leading provider of high-performance server and storage-based solutions, and they really focus on making products in the data center. Server and storage systems is their largest segment by far, and if we look here over the trailing 12 months, it accounted for 94.19% of their revenue. And it should also be noted that's where all the explosive revenue growth is happening. And in that group, their number one product is these liquid cooled racks that are used to scale AI GPU systems. AI related spend contributed to over 70% of Supermicro's revenues across enterprise and cloud service provider markets. And their direct liquid cooled rack is the market leader, and it's expected to be in 15 to 30% of new data centers over the next 12 months. And I recently came across a giant example of their products in use. Elon Musk's new startup, xAI, just built a gigantic data center, which is actually the largest AI data center ever made, and they use Supermicro Computer's racks all throughout the entire facility. And this liquid cooling solution currently is the best in class and makes it far more energy efficient. So there is no doubt that Supermicro is in use at the top of the line facilities right now. So if we are in a massive bull market for AI stocks and Supermicro Computer is actually a company making real money off of these advancements, they're getting a lot of that data center spend, then why is the stock down 75%? And is that a buying opportunity? Well, here's what I found out. The biggest reason seems to be a lack in trust and reliability in what Supermicro Computer's management is reporting. In October 2024, Ernst & Young resigned as the company's public accounting firm. They cited concerns about being able to rely on the management's representations. They had delays in filing their annual report, and I believe they actually still haven't filed their last 10K. So on Wall Street, investors are losing confidence in Supermicro Computer. However, the company did hire a special committee to investigate, and they found no evidence of fraud or misconduct. But that has not helped, as the stock is down 14.5% after reporting earnings today, which will make them down nearly 50% over the past month. And a large chunk of that has been since that news came out. So let's take a look at the latest quarter for Supermicro Computer. This is their Q1 2025. Revenue came in at $5.9 billion, which was up 181% year over year. Non-GAAP earnings per share came in at 75 cents per share, which is a 122% increase year over year. GAAP and non-GAAP gross margin came in at 13.3%. So this is a very important point when you compare it to something like NVIDIA, which is another high revenue growth AI stock. NVIDIA has like 70% gross margins. So this is definitely in a very different product category. For Q2, they're giving revenue guidance of $5.5 to $6.1 billion. They're also giving a range for GAAP earnings per share from 48 cents per share to 58 cents per share, and non-GAAP EPS 56 cents per share to 65 cents per share. And part of the reason why the stock might be down is that the company's guidance for Q2 was below below analyst estimates for both revenue and earnings per share. So on the surface level, that was not ideal, but when we take a step back, we still have to recognize that Super Microcomputer has had insane growth over the past few years. And on my dividend data stock analysis tool, you can see that revenue has just exploded over the past few years. Likewise, net income, which is used in their GAAP earnings per share, has exploded as well. This is big growth. They have $2.01 of earnings per share over the past year. So given this 15% decline after hours, that would give it a new PE ratio of 11.7. 11 PE ratio. And that's for a company growing revenue per share and net income per share nearly 100%. But it can't all be great. There has to be some risks. And there is. In terms of financials, they do have deeply negative free cash flow. And that wasn't from very high capex. It was from negative cash from operations, which I found a little odd. So I asked my AI tool a little bit about why that could be, and this is what they came up with. It says that Super Microcomputer's negative operating cash flow in the past few quarters was primarily due to the need to invest heavily in inventory and accounts receivable to support their rapid revenue growth. So basically, they overspent a lot to get inventory in those quarters. So if you were investing in SMCI, there are major risks to consider. The number one risk is management and whether or not they can figure out this whole auditing situation and they gain trust back. But that risk may clear up and be in the rearview mirror soon. And it actually may have just create a buying opportunity. But the second risk you really need to be focusing on is whether or not this growth rate continues into the future. And this Q2 guidance being lower than analyst expectations is a sign we might be moving in that direction. However, given how much the stock price has crashed, revenue and earnings per share growth only at 25 or 50% year over year would still be fantastic from the current valuation. There aren't many companies trading at a low double-digit PE ratio while growing their metrics that high and operating in a high growth category. And currently 11 Wall Street analysts have price targets for Super Microcomputer. Average price target is $59.92, with the highest being $100 and lowest $32. So that does give ample upside at the current $25 stock price. That said, 9 of those 11 analysts currently have it ranked a hold recommendation. And for my dividend investors, it's also important to notice that Super Microcomputer is not a dividend paying stock and likely will not be anytime soon. This is more of a high growth company, and realistically, I would probably make this into a 1 to 3 year trade if I were to invest. They are investing heavily into the future, so they can't support dividend payments or returning capital to shareholders. They're not doing buybacks, they're actually issuing more shares to raise capital. And unlike Nvidia, who's much higher margin and outsources their manufacturing to TSMC, Super Microcomputer actually manufactures themselves, and they're investing in expanding their manufacturing capacity with new facilities in Malaysia and in Silicon Valley, Taiwan, and Europe. So this is a different kind of company than I usually analyze on the channel. It's a lot higher risk, but given the overwhelming decline in stock price, it is a potential buying opportunity. But as always, do your own investing research and do not take anything I say as the gospel. You should always make your own investing decisions. I'm unlikely to buy Super Microcomputer, but it's definitely a very interesting one to analyze in today's market. So thank you for watching Dividend Data. Be sure to leave a like and subscribe to the channel. And as I mentioned earlier, you can sign up for dividenddata.com and ask our new AI tool, Dividend Data, a question. You can get 50% off with the promo code AI at checkout, or click the link in the description and pin comment to sign up. Thank you for watching.